Hey guys! This is part 3 of the series. This is just going to be recapping what it is that an accountant does, just to sort of set a basis for making financial decisions. I know some of us don't all come from a accounting or finance background, so this is just clearing up a few concepts. So things that an accountant produces is the cash flow, the balance sheet, and the income statement. We're going to have a look at those a bit more closely. So we looked at a cash flow in our other class, and it's pretty simple. We look here at where the money is coming in, we look here at where it's going out, and then see how it balances out. So here we've got a £400 investment, and nothing is spent, so our final balance is 400. If we look at this month though, whilst we don't have anything coming in, and we do have 100 going out, so we have cash out of 100, so the total cash flow is 100, but because it's going out it's a negative, we still are positive overall because we had that initial investment. If we look at this month then, we have both an income and an outgoing of 100, so whilst our cash out is 100, the total flow equalizes to 0 because it's the same both ways, which means our balance stays the same, etc, etc. So on our bigger cash flows, we do this for the year, and then in a final column we'll have the total of that year. And so we'll see all the money that came in from cash sales, or from receivables, or from loans, and then all from investments, etc, all the way down. And then at this bottom row, we see that overall, all the different cash flow that's coming in, and then the balance of it all. So if you think of this column here, this is going to become our income statement, showing us where the money is coming in and out. And then this here is essentially what our balance is. So if we wanted a balance statement for the month, it would be one of these variables here. But if we carried this along, so that the final column of at the end of month 12, whatever that final balance is at the end of the year, that's normally what we see in a balance sheet. So an income statement looks like this. So this is all that money that came in, this is all the money that comes out, and then we equal them out to see how much money that leaves us with. So this is looking at the money when you take these from each other. And then we have to pay tax on all the profits, so we take that away from the profits altogether, and that means that we have our final profit after that, which can either be reinvested in the company, or it can be shared out to, as dividends, or go towards paying off loans. Then in comparison, this is a balance sheet. So this will be showing all our positive money, and this is how that is sort of shared out around the company. So for example, we might be having this cash here coming in, and so some of it we're going to have to pay out towards accounts that we owe, taxes that we have. And then some of it is just owned by us. So for example, we might have invested into property, and as part of our shareholder ownership, we have ownership of that property, and that's where the value is stored, if that makes sense. So you're seeing where the value is shared, how much of it is a debt, and how much of it do you actually have ownership of. The reason why this is important is it's going to show you, you may have a lot of money at the end of your balance, but if a lot of it is going towards stuff, is going to have to go towards your debt, then you may not actually be in such a good financial position. So if you think of it then, your balance statement is measuring the stock and who has claim to those liabilities. And then your income statement is measuring the flow. If you have done calculus before, that means that it's the variable and its first derivative. For people that aren't from a mathsy background, that's basically how much you have and the rate at which it's changing. So if we say that these 3 coins here are our final balance for the year, we might show that the flow of that money started as 5 coins coming in, but over that time we also had 2 coins going out, which left us with the final 3 coins. We then have on the balance sheet, it will be looking at these final 3 coins and we're going, well, what do these final 3 coins consist of? So this bottom one here is a loan. So we may have that coin, but it's not ours to have for the long term. It belongs to somebody else in the long term, but they're lending it to us. Whereas these 2 coins, they're ours. We earn them and they are our asset. Now, derivative, which we just talked about, the first derivative, this is a term that some of the more like mathsy people might know, but also it's used in finance to kind of describe a bit more than that. So I'm not going to be the expert at this, but if you go on to this website, Investopedia, they'll be able to explain what a derivative is. It also goes into like securities. So essentially your derivative is something that you're putting down to capture a security in time. So it explains here that originally they were used for exchange rates. So if I was trading with someone from a different country, then it would be useful for me to decide if I've got a good exchange rate and I want some kind of reliability. I can lock in an exchange rate so that instead of the company overseas saying, okay, well, I sell my goods for $2, and then that changing from my end, I can say I'm going to buy your goods for £2, and whatever that looks like in a dollar, it is up to them. So we can set the exchange rate that it'll be a certain thing, or I can say okay, well, your $2 is always going to be worth £2.50 to me. I know that's not the actual exchange rate. And so if they put their prices up to $3, then my price would go up in ratio to that, rather than just to the exchange rate of the day. It can also be used for other things, which it will explain if you go onto that website. It's going to explain it a lot better than I am. And then they also have a page on securities in general, which I kind of flicked past a bit. So it goes into equity, debt, balancing them all out, etc., etc. Basically, what you need to know is that all these securities are put in place to minimize risk. So, for example, somebody might say, I'll give you a loan, and that loan will be worth £50,000, and you might be investing in a property for £50,000. So the conditions of the loan are that I will lend you that money, and if you can't pay that money back, I get that property. And that would be a secured loan. An unsecured loan would be, I'm giving you that £50,000, but I'm not securing it against anything. So if you can't pay it off at the end of the day because you're a limited company, then that means I just won't get that money back if you don't have the assets to pay it off over time. So financial decision making looks essentially like this. You have the finance manager, and what they're looking at is the difference between investments coming in and money that they're having to spend on operations. So the relationship between 2 and 3, this is your real investment decisions. How much money are you going to put into operations with the hope that it will come back out again and be making some kind of profit? Essentially, if you put more money into making more stuff, you can sell more stuff. And so that's one of your decisions to make. The other is to look at these ones, 1 and 4. That's your financing decisions. And so they're looking at what's going to be the better outcome for me. Do I want to reinvest some of the profits that I made and have that slow build up, or do I want to have a big investment from somebody else, but then I'm either going to have to give away shares to that person or I'm going to be in debt to them. And it's balancing out which is the more appropriate option. If you're going to take a loan, but it's going to mean over time you have a much bigger profit, then it's going to be worth taking that loan. Whereas if your profit over time doesn't increase by getting that loan, you might be better just to be reinvesting your profits and have that steady growth where you're not at risk of becoming bankrupt. Number 5 is looking at the payout. So balancing out all those decisions. How much are you willing to be paying out to people maybe outside of your company if they're the ones that are now holding shares? Like I've said before, once you've sold those shares, you will be paying dividends to those people, and that doesn't necessarily mean that that money keeps being of worth. Those shares keep being adding worth to your company. We then look at 1 and 5. This is when we start looking at risk management. So we might want to take a certain amount from somebody, but can we really pay it back to them? If we don't think that we can pay it back to them according to our agreement, then we don't want to be taking that much money from them. Yeah. So essentially our objective is to create and maximize shareholder value. That's meant to be the role of a business. Other businesses like my own, which is going to be a social enterprise, I'm looking to make sure that these operations are running at the highest. So my role is actually to make sure that any investment is going to be of maximum use to the operations and the customers involved. That's all for this one. See you in the next video.